Investment properties are one of those things we all strive to. For some reason, us Australians just want to have that investment property. It sounds good at the family barbecue. Everyone seems to feel that the tax benefits that the government gives are very worthwhile. There may be some changes in that space, so it is very, very important you keep your eye on that, because they're looking at rolling back negative gearing. They haven't done that yet, but it could certainly affect the cash flow. When you're buying an investment property, you're really buying for two reasons. Either one is capital growth, or the second reason is cash flow. When clients have bought negatively geared properties, that means the rent doesn't cover the mortgage. There's a shortfall of a few $100s per week, and they've got two or three of these. Two things happen. One, the bank stops lending to them because their shortfalls consistently add up, and it chews away their serviceability, so their income cannot afford any more investment properties. The other fact there is that if they lose their job, all those properties then are at risk of having to be sold because they don't have the cash flow to keep topping up the difference between the rent and the mortgage. So those negatively geared properties are very, very finite. They're based on your income, and a lot of people are buying negatively geared properties with a mindset of it's going to help them retire earlier. It actually does the opposite. Buying a negatively geared property chews your cash flow up, and you're sitting there hoping for capital growth. I really feel that capital growth around Australia for the next few years is going to be pretty limited, if any at all, just the way that the market is, especially once rates start rising. It's going to really, really cool off a bit. So if you're buying for capital growth and you're sitting hoping it's going to grow in value over the next 2 to 3 years, I think you'll be sadly disappointed. And there's nothing worse than paying $200-300 per week shortfall between the rent and the mortgage. If the property's not growing in value, what's the point? And so you're just draining your cash flow there. Buying for cash flow is a different story. When you're buying a property which puts more money in your pocket than what it takes out, that's the name of the game. You're being paid to own Australian real estate. There's nothing better in life than actually waking up and knowing whether or not you do or don't go to work, that property is going to pay for itself and some. There's only one factor which determines when you can retire. That is when you have enough assets producing a passive income that's going to cover all your living expenses and give you that lifestyle there. Positive cash flow properties consistently build that cash flow so you can retire faster. Negatively geared properties diminish your cash flow. So you should be buying for cash flow over capital growth, because capital growth you can't control, the cash flow you can. Rents are usually trending upwards year after year. The third option there when you're buying for investment is to actually look at manufacturing the equity or manufacturing the capital growth. An example I've just done is I bought a property in Adelaide. It was a corner block. I paid $350,000 for that property. That property is on 880 square meters. We've just got council approval to then subdivide that into 3 lots. So we've got one house at the moment. We've knocked that house over and we've actually built 3 units on that block. Each unit costs $200,000 to build. So that's $600,000 for the 3 units, plus the $350,000 for the purchase price. So it owes me around about $950,000. That valuation today on those 3 units is at $1.35 million. So as you can see there, I didn't wait for any capital growth. I wholly and solely bought, subdivided the land 3 times, and now I've got 3 parcels of land giving me 3 rental incomes, 3 sets of depreciation, and as a result I've created or manufactured the equity. And so that's something you should definitely be looking at. After you've bought a few properties, you've sort of dipped your toe in the water, that's a great way to build your wealth and create equity.